Time to take your wealth to the next level. Welcome to Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth together.
How's it going, everyone? Hope you all are doing great. Today's episode is going to be juicy. I'm not sponsored by this coconut water, by the way. Today's episode is going to be Houston market real estate update with an extra juice of macroeconomics point of view. So stay till the end, because even if you live outside the Houston area, the macroeconomics part of this video will be very valuable to you. Yes, many realtors in Houston and in whatever area you're in are experts in the local real estate community. I say many, not all, so beware. But why does your real estate agent need a good macroeconomics understanding as well? Nothing to see here. It's all tinfoil hat stuff. You know these gray areas right here in the Federal Reserve's website? They're recessions. Yeah, they say real estate market is hyperlocal, but how come nearly every single home's local markets, buyers and sellers in the US were affected in that 2008 crash? So let's go over the local Houston market first, then we'll zoom out on the 30,000 foot view of macroeconomics. Let's break it down. As of August 2024, the Houston real estate market is showing some interesting dynamics. Days on market. The average number of days homes stay on the market has increased in various areas around Houston. For instance, homes in the Katy area average 27 days on the market, while in Kingwood, it was around 62 days. Some areas have seen homes taking even longer to sell, such as in Humble, where properties were on the market for as long as 210 days. Inventory. There has been a notable increase in housing inventory. The months of supply for single-family homes in Houston jumped to 4.3 months, up from 3.1 months the previous year. This indicates that the market is gradually balancing, with more options available for buyers, especially in the townhome and condominium segments, where inventory has hit the highest level since 2012. Price adjustments. The market is also seeing more price adjustments from sellers. In general, some properties are selling under list price, with discounts ranging from 5% to 12%, depending on the area and type of property. Despite these cuts, the average price of a single-family home in Houston still saw a modest increase of 4.7% year over year, reaching a new high of $445,440. Wow, average price in Houston reaching a new high of $445,000. Well, ain't that great? Yeehaw, Texas! Market is booming. Houston prices are going up, so you better act now before you miss out. FOMO. You'll have these realtors putting the FOMO on you. Fear of missing out. Here is what your real estate agent is not telling you. Most new constructions, they would say, oh, we're selling a lot of properties. Everything is moving. But these new construction builders also have been helping the buyers on about $10,000 to $15,000 on closing costs. They have also been buying down rates to 4-something% instead of the 6-something% that we're actually in. And all that closing cost assistance and buying down rates does not get reported in the comps. At the end of the day, without these crazy assistance for home buying, these homes wouldn't sell that much. I'm not saying down payment assistance and buying down rates are wrong, but when they say the price in Houston had a moderate 4.7 increase year over year and is now averaging at $445,000 per home, is that really all there is to it? Is that the complete story? I want my viewers, the Learn Wealthy community, to have a better understanding of the Houston real estate market. So please subscribe to my channel if you find this channel helpful. Also, if you need an honest real estate agent who would not FOMO you about the market, I have my email down below. Okay, enough of that highly concentrated juice. It's time for the yummy juice, macroeconomics. Alright guys, it's time for the nerdy stuff, but stay with me. So we're here at the Federal Reserve's website. I always use the government websites because, as you know, Americans, they love and trust their government so much. All right, we're at 10-year, 2-year Treasury. And as we know, the yield curve it means the spread on the 10-year and 2-year treasury, it's massively inverted right here. And whenever we get an inversion right here, inversion right here, inversion right here, it's followed by an uninversion when the blue line goes above the black line. Uninversion, and then we get a recession. The recession is the gray line. So not me, but the 10-year and 2-year treasury, because we're inverted right here, is saying that we're headed for a recession. But not all recessions makes all the house prices go down or up. This is the recession, the 2008 recession. This is the one where we had a housing crisis. And here, the 2008 recession, this is also a Federal Reserve chart. This is the Case-Shiller Index, where they average out the home prices in the U.S. As you see, we're in a bubble around 2006, 2007. And then we hit the recession. And house prices doesn't crash like the stock market. It grinds down slowly. We didn't hit rock bottom till 2012. So if we hit another recession like this, then and real estate grinded down slowly in value like this, here all the way here, bottomed out 2012. Then you have around here to buy. That's about 2008 to 2014, where it's amazing to buy a house, because then we had this bull run right after, right? But now we're in this bubble, I would say. This is 2006, 2007 bubble. We are here right now. How much drop would that be? You know, the higher you are, the harder you fall, right? So, yeah, that's the national home prices. Again, it's not my opinion. Federal Reserve's data. Let's go to the Buffett indicator, the stock market to GDP, to the U.S. economy ratio. So during 2006 and 2007 bubble, the stock market is only 105% of the GDP, or the U.S. economy. Some say that the stock market should only be 70%, or about 70% of the economy, because the stock market only represents the public companies that are traded in the stock market. The stock market it's not representing the mom and pop shops. That is a very huge part of the U.S. economy. So we're here right now where the stock market is 188% of the U.S. GDP. So basically it's saying here in the Buffett indicator that the stock market is 2 times the size of the U.S. economy. Sounds like a stock market bubble to me. So you mean to say we're in a real estate bubble and the stock market bubble? That sounds like an everything bubble. Well, we haven't been into the bond market yet. Now we're in long-term trends. This is home price to median household income ratio. Like I've always been saying in this channel, it all goes back to what people can afford, people's income. Prices can't just keep going up and up and up and up forever without any consequences. Who's buying these assets if people's income can't afford it? So at the end of the day, historically, all these asset prices get ups and downs, bubbles and dips and bubbles and dips. But eventually it all goes back to the income, because it's the people, it's the real economy that are buying these assets. So it says here in long-term trends, historically, the average cost of a house in the U.S. has been around 5 times the yearly household income. However, during the 2006 bubble, this ratio exceeded 7. In other words, the average single-family house in the United States costs more than 7 times the U.S. median annual household income. Where are we in 2006 bubble? Home prices are 6.77 times the median household income, where it's usually should be just around 5. Where are we right now? At this point, we're at 7.66%. Again, sounds like housing bubble to me. When the Psalms rule was triggered, first week of August, it's when the unemployment, it went up enough to trigger the Psalms rule. And as you can see, whenever the Psalms rule is triggered, we're always in that gray bar, a recession. Right here. When that blue line passed the black line, we're headed for a recession. Psalms rule, recession. Psalms rule, recession. And we just trigger the Psalms rule right here. So we're arguably in a recession. And a lot of times NBER, the entity that officially announces recession, they don't announce the recession forward. They don't say, oh, we're going to have a recession. They say, they always say, we've had a recession a year ago. And on the first week of September, around Friday, we're going to have another unemployment report from the BLS, Bureau of Labor and Statistics. And we're going to see if this employment will rip higher. Then that will enforce my base case that we are heading for a recession. Or if the unemployment improves, then we'll think about it more. So that is a macroeconomic view. If you found this video helpful, give it a thumbs up, share it with others, and let us know in the comments if you have any questions or topics you'd like us to cover. If you need an extremely knowledgeable real estate agent, not only in your local market, but also in macroeconomics, and who's kind, loving, and honest and won't FOMO you into buying a property right away, my email is down below. For more real estate, macro, and finance, please subscribe to Learn Wealthy so we can all learn wealthy together.